Hey everybody, it's Bob from Trade Genius. Got my good friend Phil here. Hey, the bond market's no joke. Phil's going to tell you all about it. Stay tuned. Very, very important information.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes, and if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co, check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live, and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that.
Okay, Phil, we've been talking about this inverted yield curve for quite a bit of time now. Yeah. And it's not so much the inverted yield curve that's a problem. It's when it starts to unwind. Did I get that right?
Yeah, that's exactly right. In fact, let's just switch over to the charts and get right into it. So what we have here is your classic, when you're talking about yield curve inversion, more often than not, you're talking about the 2s and the 10s, the 2-year and the 10-year yield for the US Treasuries. And so we've been inverted. You can see that on the right there in the red circle. We've been inverted under 0. And so we're expecting now for that to start to normalize, meaning that it's going to go up. That's what this green stuff here is basically projecting out how the yield curve, you would typically expect the yield curve to go back up. So what does this mean? Well, if we look back in the last 2 recessions, you'll notice in the dot-com bust, we had a yield curve inversion. And then as we started to normalize, we went up to all the way up to 2.3%. And so we were going to expect to see something similar. That's why you're starting to see some of these hedge fund guys short the long end now. They're shorting the 10-year because they know that the odds are we're going to have an extremely large spike on the long end of the curve to normalize this yield curve back to the way we're used to seeing it. So think of it as just, this move has been building and building and building, and now the spring's finally starting to pop. The interesting thing that we can, information that we can glean from the bond market is what happens when we go from periods of extreme yield curve inversion and back through the normalization process up to like this 2.3%. And that is that you enter in the last 2 recessions, 100 weeks basically of a bear market. And this is something that you'll notice, right? If we take prior to the dot-com boom, very just linear move up, very little in the way of corrections, just mostly up, right? And all of a sudden it runs out of steam, rolls over. What's happening? Yield curve inverts, starts to normalize. Same thing going into 07, 08, right? Up, very little correction, starts to level off, roll over, yield curves inverting there, and then we normalize through this thing rolling over. Both of these times, over 100 weeks, about 119 weeks is what the shaded area is covering. Okay. And then what happens is you finally get normalization. You finally hit 2.3% on the 2s and the 10s. And that gives you very close to where the end of the bear market should be. Okay. So where are we now? We're just coming off the lows. We're going to start our 100-week count back in about the start of June. Interestingly enough, that's when the debt ceiling was raised. And so we're looking at a projection here now, these red candles we're projecting out. If we go off the 2s and the 10s, that's going to take us all the way out to October 2025, guys. And then we'll finally get the bottom of the bear market as we start to hit our normalization up here at 2.3%. So that's the 2s. That's what the 2s and the 10s are telling us. The other one people like to look at is the 3-month 10-year. So I can flip to that chart. And it actually has a little shorter duration on the bear market. This would be about 20 weeks shorter with 100 weeks duration. But similar thing where, when we get up towards the first part of this, would be getting up towards 1.8%. Usually by the time you get to 1.8%, this market is done going up. Sometimes it's already putting in lower highs. In the last recession, once we got to 1.8, this market was definitely done with any more highs and it was rolling over. Otherwise, prior to that in the dot-com boom, it started to roll over prior to that. And so we have yet to see if we're going to get, if this is going to be a lower high here, or does this market have enough juice to get back to the all-time highs? That we just have to wait and see. I think the evidence before us is that with the bond issuance and what the Treasury is doing now, and with the reverse repo really drives, see, reverse repo wasn't in play these prior 2 recessions. Reverse repo is a huge key in the equation here. And so if reverse repo is rolling over, which we think is going to happen now, then we would think that we might get more of a scenario of the dot-com bust, which would be kind of on par because, a lot of this AI bubble stuff is very similar to the dot-com stuff that we saw back in the 2000s, early 2000. So we would start rolling over before we get this meat of this move up. But in any case, you're looking at a normalization back up to 3.5% on the 3-month 10-year, which would take us out to about the first quarter basically of 2025. And then we would look for a bear market to end there. So there's a couple ways this could go. But essentially what they're telling us is that next year is not going to be pretty for the market. We're not going up. It would be a bear market. And then either Q1 of 2025, if you think the 3-month 10-year is right, or if the 2-10 is going to be correct, we could go deep into 2025, which I don't think anybody is forecasting that right now, Bob. But I think you have to look at what the bond market is setting us up for. And you have to adjust your thinking that this could be exactly what plays out ahead of us.
Yeah, Phil. I mean, this is awesome stuff. I mean, think about it. If you can get the Federal Reserve to do all the hard work for you, and you own a ETF like TLT, or they own long bonds, and the price of the interest on long bonds drop by half, the principal of that bond is going to skyrocket. And so, because that still has the same coupon. And so it's so much easier for pension funds and hedge funds to say, you know what, if I can make 50%, in the next 18 months on just sitting in bonds, why take any risk on a equity, for a corporation blowing up or something happening or this, that, or the other, when I can just get the free and easy because the Fed has my back. That's why these unwinds are so decimating for the markets. And what we talked about earlier, that's where you make the money, is just get in TLT or ZROS and just sit back and relax and, and collect your profit over the next 12 to 18 months, because that's what's coming. Hey guys, that's all we got. Hit like, hit subscribe. Thanks for tuning in, and enjoy your weekend. We'll catch you next week.
See you guys later. Bye-bye.
Trade Genius.